Saturday morning to you, and welcome to On the Mark. Alongside Mark Pappa, I'm Gary Byron. Mark is with Financial Resources Group. They're out of Glastonbury, Connecticut. Of course, you can find them online at www.frplan.com. FR, Financial Resources Group. frplan.com. Very easy. You can call him, 860-657-8380. Of course, we're doing the show right now, but in half an hour, he'll start taking your phone calls or later on in the day, anytime during the weekend, even into the week, as long as you make that phone call. Of course, there's never any obligation, but it all starts with a phone call, 860-657-8380. And if you missed any of those points of contacts, no worries. I'll repeat it at least a couple of more times before the show is over. Mark, good morning. Great to see you.
Good morning, Gary. How are you? Welcome back to another week.
My goodness, these weeks they go by so fast. Actually, next week is Thanksgiving week. Thanksgiving, and you got Black Friday, Thanksgiving weekend, the kind of the beginning of the holiday season. That'll be a very nice time of year.
Yeah, here it comes. I went to the gym it was actually last week, believe it or not, and went to the gym, and the first thing I saw, they had the front desk decorated for Christmas already. So,
getting a jump on things.
It's such a typical, but you know what? The world has changed, and we all wish every day could be Christmas, right? Growing up, and you're going to pull it forward. But it'd be nice to get the holidays and see the family, and do what we normally do.
Things slow down for you usually around Christmas time?
No, not really. I've been one of those advisors where the week after Christmas, for some reason, because it's so hard to get people in the office, they have the time off, they come and see me. I've actually stayed busy. And then, of course, I'm also working in January as well, when I think I'm going to wise up and take a break the first and second week of January, take a trip just to kind of reboot a little bit. But
nice.
Yeah, I'm gonna take a hard look at it, but it's hard for me to do stuff like that.
You've been on 2 vacations to my 0, so I'm overdue. I'm jealous though. But
I am not a traveler at all. I hate it. And here's the bottom line: packing. This is my new rule too. Even for traveling for business, if I can't go somewhere where all I need to pack are shorts and flip flops, I'm not going.
Go south.
I'm done.
When it's cold and snowy up here, go south.
I'm not putting my suit and my suit jacket in a suitcase. I'm not calling room service for a steamer. I'm done. I'm not doing it.
Happy to hear that.
Yep.
I really am. All right. You know what? Last week, of course, this is very typical of us when we get together and do the show. We were having a great conversation, and then just time got the better of us. That's what happens when you get two paisans talking this topic. We just get to talking and talking and talking. I kind of just briefly, I want to talk about a couple of things this morning, including fees and beneficiaries, the whole 9 yards. We were talking a couple of weeks ago about the full checklist. But I just wanted to, there was a question I really wanted to get to that before we ran out of time, and it had to do with COVID. I mean, we had some gut-wrenching drawdowns. The COVID crash in early 2020 saw the S&P plummet like 34% in just like 6 weeks, from February 19th to March 23rd in my research. This is when the lockdown was really hitting. And then 2022's bear market, there was a 21% drop in the first half alone. The worst start to a year since I think it was like 1970.
Right.
All fueled by Fed hikes, and remember Ukraine and inflation, and then just this spring, we can March to April of earlier this year, 2025, tariff talks under the new administration. That sparked the panic. The Dow shed like 2,200 points in just one day back in early April. Yeah. The S&P was down 5%, NASDAQ 6% as a 10% baseline tariff. It all kicked in on like April 5th. The markets hit yearly lows by early April. So these weren't exactly AI specific, but they did show how quickly sentiment flips. So here's my big question to you that I really wanted to, just ran out of time last week, but I wanted to ask you, are we due for another?
Well, I mean, it can happen anytime, Gary. I can tell you nobody saw the COVID coming. No one saw that coming. I mean, people were talking about it behind the scenes, but no one really saw COVID coming. No one can really call when, I mean, we understood there was some risk of tariffs, but did you know Trump was going to say we're going to do 100+% on the Chinese one day? You don't know that. No, you can't. Those are all, COVID is what you would call in economics terms an exogenous shock. So for lack of a better term, I like to talk more plain language to you, ladies and gentlemen on the audience, but that's an outside shock. The tariffs we kind of knew what we were dealing with there, but we'll call it a tariff tantrum. Then we had the taco trade where Trump, changed his mind but yeah, it can happen anytime. It goes to show that we're in a market that is ultimately priced to perfection. That, even great behavior is still not rewarded with more behavior, with more buyers, that we have to be super careful as to what's going on.
Well, sage advice from you there, my friend.
And so let me just talk about some metrics that we like to use.
Okay.
By the way, this is as of November 11th, when I put this together. So that was about
a week
not
and a
long
half
ago.
Yeah.
So I want to talk about the Schiller PE. And Schiller PE, for those of us who live in Connecticut, is actually a very famous Nobel Prize-winning professor by the name of Robert Schiller. He's a Sterling professor at Yale University, the professor of economics. And actually, Gary, I went on, you can go online and listen to some of his classes. If you really, for some of you, if you have insomnia, you may want to listen. But for guys like dorks like me, I can listen to this guy forever. And I can understand why Yale has him as an economics professor. I mean, I can just keep going and going and listening. And he's an amazing, amazing guy. But the Schiller PE is also known as the cyclically adjusted price to earnings ratio, the CAPE. And it's a valuation metrics for the stock market developed by economist Robert Schiller. And it measures the price to the S&P 500 index relative to its inflation-adjusted earnings from the previous 10 years. Now, providing a smoother, longer-term view of the market valuation compared to traditional PE ratios. Historically, values above 30 suggest the market's overvalued, while 15 indicate undervaluation. And as of November 11, 2025, well, unfortunately, it stands at a 40.40. So it's well above its historical norm. And that could be an indicator that the market's obviously not undervalued, but it's overvalued. Warren Buffett's not a buyer in this market right now, and he is kind of retiring, and he wrote his last Thanksgiving letter a couple weeks ago. But, the bottom line here is we're looking overvalued. And then we have Warren Buffett, the Buffett indicator, popularized by the Oracle of Omaha, Warren Buffett, it's a simple gauge of stock market valuation calculated as the total market capitalization of all publicly traded U.S. stocks, so the value of all the publicly traded stocks in the United States, divided by the country's gross domestic product, expressed. Okay, so bottom line is, all the goods and services produced locally and domestically in the economy, roughly. Okay, not going to get too deep in the weeds on the definition, but it's expressed as a percentage. So it reflects whether the market is priced, where it's priced relative to the overall economy. Now, Buffett has described levels around 70 to 80% as ideal for buying, while over 200% signals extreme overvaluation as playing with fire. So, as of the 11th, the latest available data, the Buffett indicator was a 223.3. So above the 200 or below, Gary? How far are we from the buying signal?
Yeah.
70 to 80%, right? So, people are hopefully dollar cost averaging their money into the market little by little. You put in a little bit at a time. This way, if it dips, you don't get hurt too bad. If it goes up, but you want to get rich slowly. And that's what Warren Buffett was very good at doing, is picking the right companies, doing the research, looking at, a stock that he wants to own for 20 or 30 years or more, who's well managed, has a great brand, isn't going anywhere, pays great dividends, has rising earnings, has a good balance sheet, doesn't borrow too much debt, doesn't have any gimmicks on its, earnings call. And that's what Buffett's good. And even Buffett gets fooled once in a while. But long haul, I mean, he's by far the best ever in history, best investor as far as I'm concerned. So
even to this day.
With
all the other names that are out there, and
look, anybody out there, there's so many people who are trying to copy Berkshire Hathaway, trying to copy Warren Buffett. There's only one Warren Buffett. There's only one Charlie Munger, and those two are incredible. So I applaud Buffett for his many years of giving advice and teaching people and his simple way of explaining things. He's just an amazing guy. So, it's sad to see him retire, but I mean, he's getting old. I mean, he's in his 90s. He's going to enjoy whatever last bit of life he has. I think he'll keep doing what he's doing, but I think he understands the reality that it's time to hand the reins over to some new blood. So it's going to be interesting to see who he picks.
So he's kind of semi-retired now. Who's that new blood then?
Yeah, I mean, they've floated some names out there, so I don't really know.
Children that are?
I think his children are going to run the
mean,
nonprofit foundations. He's going to be leaving a lot of money to.
Okay.
Yeah, and then one other thing I want to bring up the Buffett. I hear this a lot at seminars. Oh, well, why don't I just buy the S&P 500? Because that's what Warren Buffett's going to buy for his wife. And my answer is, you're not Warren Buffett's wife. You're not Warren Buffett. Okay. Yeah. If someone wants to leave me $50 billion in an ETF exchange in the S&P 500, I'm happy. I could live off the dividends all day long. But you're not worth $50 billion. Okay. You're worth $1 million, $2 million. Putting your entire retirement in the S&P 500 after some of the conversations we've had. You're fine until the markets cooperate. You're not fine when the markets don't cooperate. And that could really nail you and hurt the long run of your income. If you lose 20, 30% in a year, you're drawing down your money. Now, you either can't take your money out because you're trapped, or you have to take it out because you don't have a choice. And now you've just hurt the future, in any future increase of your retirement that you're going to take from that money is probably gone. So that's what they call sequence of return risk. So you can get hurt pretty bad in down markets if you're living off the money.
Is Elon Musk worth $1 trillion?
The board believes he is. I'm a Tesla shareholder, for full disclosure. I was pretty happy to see that they voted that for him to stay on. I think the next level for Musk is going to be in the AI space. It's going to be the humanoid robots. It's going to be the driverless taxis.
Well, he's already started on that for 10 years.
Yeah, but some of the claims he's making for the humanoid robots are pretty extreme. And he actually believes that the humanoid robots are actually going to be operating on us one day with more precision than an actual surgeon. I don't know. I'm not sure I would allow that.
I was going to say,
I
don't know if
you don't know, Gary. So he's a futurist, just like all of them. So I think he's going to be the fastest deployment of these AI robots. I think it's going to be the fastest deployment in history that we've ever seen. So I wouldn't bet against the guy.
Is this a good thing or a bad thing?
Betting against Buffett. Huh?
Is this a good thing or a bad thing?
What? That he's a $1 trillion pay package?
No. Well, about the advancement, not so much in medical technology, but humanoids and just replacing humans. And like you just said, you wouldn't know. You wouldn't have it yourself.
Yeah, I think it's going to be a while. I think most people are going to want what they're calling human verification. If you look at the AI trade, you look at AI in general, the holy grail of AI is what they call the agentic AI, meaning there's no human verification and it thinks for itself just like a human being, agentic. So that's a little scary to me. Yeah, that's a little hell.
But AI being supervised by humans.
Yeah, I think that's going to. It's already created a lot of productivity. I know people everybody I talk to that uses ChatGPT or Grok or DeepSeek or any of these products has become a lot more productive in their job. And I think it is going to, wipe out a lot of mundane type tasks in the beginning. And then over time, I think it's just going to create new opportunities, new industries for humans to make money. I mean, let's think about it. And you saw what happened. Yeah. If it gets too powerful, though, that is a scary thing. And again, think of, 2001 Space Odyssey, right? Kubrick and HAL. That is old. That's an old movie. So Star Trek is a long time ago. So think about how long these futurists have been thinking about. And those realities, a lot of things are becoming a reality now. It's amazing.
I want to do something and go back maybe a couple of weeks ago to your checklist.
Sure.
And I wanted to talk about, beneficiaries, more like accounts. Are they titled correctly and some of these kind of
things? Let's get into that. So, Gary, this is part of the full checklist, and I can't tell you how many times somebody comes to me. They'll have a brokerage account, and it'll just be their name and they're married. Or it'll be themselves and the spouse, and it'll say JWTROS, which is Joint with Rights of Survivorship. And everybody thinks, oh, that's fine. I titled my account right. And I'll say to them, so you have a joint account? And they'll be like, so can you both put money in and out of the account? And they'll say yes. And can you take money in and out of the account? Yes. Can you write checks out of the account? And they'll say, yeah, absolutely. So it's a great thing, right? Joint account's a good thing. And they'll be like, yeah, it's awesome. It's super easy. And, if one of us needs to spend a little bit more than $500, we kind of sit down. We have this little rule that, we need to agree to, see who gets to spend, if that's okay, then we're fine with it. But for the most part, we use it to pay our bills, and, he'll put his piece in and he'll pay the electric, So I have these conversations. So that's great. So you have a joint investment account too. So that's your checking. And then you have a joint investment account. And they're like, yeah. So I'll say, so if something happened to the both of you, one of you, it would go to who? And they go to my spouse. And she'll say, so something happened to the spouse, it's going to go to who? It goes to him. And I go, great. So I said, well, now, what would happen if something happened to both of you? Where would the money go? And they'll say, well, we have a will. And I said, so you have a will? And I'll say, in a will, and when you die, Gary, where do you take that will? What kind of court do you go to?
Right, probate court.
You go to probate court. So I'll say, so you take the will, you go to the probate court. Mm-hmm. And I said, now how long in the state of Connecticut does it take for that will to go through probate?
Wow, that's quite a while.
It could take a while, right?
Yeah.
I mean, given most people have a simple situation, I think the state, and again, I'm not a probate expert, I'm not a lawyer, but I think they have at least a year to call on creditors when you pass away. So it could take a while, depending on how fast you get the paperwork done, depending how easy it is to do, depending how quickly the court can process that case, right? As long as you have the will, you should be okay. But I'll ask them, while that money is sitting in probate, is that money accessible to your beneficiaries?
I don't believe it is. No,
right.
Well, not if it's in probate. And
they freeze it, right? And I'll say, well, but they're going to get the money eventually, so is that such a big deal? And they'll be like, well, probably not. But I'll say, well, if they have to go to the court, who do they typically have to hire?
An attorney.
Got to hire a lawyer, right? And do they work for free, Gary?
Hell no.
No, they're not working for free. So they're going to be involved. So that's going to cost some money. And while it's sitting at the bank or the brokerage firm, do you think the bank is in a hurry to get you that money, or they're telling you they're going to give you that money right away? Your kids, are they just sort of happy to sit on it and say, don't worry, your money's safe for now?
Yeah, the latter.
The latter. And while the money's sitting at the bank or brokerage firm, guess what the bank is doing and the brokerage firm is doing? What's happening with them? Are they working for free, or are they also getting what? So they're getting paid, right?
Of course.
So it's sitting there. So I asked people I said, so when you first open your accounts, I said, did anyone tell you that you could completely avoid probate? I'm like, no one mentioned that up. And I said, why do you think they didn't bring that up? And they're like, well, we're not really sure. I go, okay, fair is fair. I'm not really sure. And I'll say, well, does the bank care that you're parking the money there, for the next 6 months or 8 months?
They're happy.
They're happy. And I'll say, why are they happy? And they'll say, well, because they're making money, right? Slowly but surely. And then I'll say, well, let me ask you this question. Is your advisor upset that the money's sitting there? And they'll be like, well, no. And I said, and why? Gary, do you think they say? Because he's making money. But I'll say to them, do you realize that the same paperwork that you open, when you do all your paperwork, Gary, to open up a new account, that there's a simple little form that all you have to do, instead of having to take the will through probate, that all you have to do is fill out that form, one extra form, to make sure that your beneficiaries don't go through probate. Now, is that a big deal to fill out?
No, it seems pretty simple to me.
Pretty simple, right? Is it going to take hours or just a couple extra minutes?
I don't know. It doesn't seem like it wouldn't take that long at all.
Yeah, it doesn't take long at all. So super easy. So what we do is we tell people, very simple, easy fix, that when they come on board, that we would take care of that and we'll get that fixed for them.
Let me do this really quick.
Sure.
Folks, you are listening to On the Mark along with Mark Pappa. I'm Gary Byron. You can, of course, find him online at Financial Resources Group's website, www.frplan.com. And you can call him very easily at 860-657-8380. Don't worry, I'll repeat all of that more towards the end of the show. I just want you to continue with that thought, though, Mark.
Well, so we'll say to them, all it took was just filling out one extra piece of paper to make sure that your children didn't avoid probate. Why do you think that didn't happen? And they'll say, well, he might have, and I'll be, look, benefit of the doubt, maybe your advisor or your banker could have been busy that day. Maybe they're just a little bit busy. But I'll say, what's happening to you is while you're alive, they're making a fee. right? But they're also, when you're dead, they're making a fee. And so they're doing it to you, but who else are they doing it to? They're like, my kids.
Yeah.
Yeah, they're making kids. So I said, why do you think they're in not such a big hurry to fill out that form? And they'll tell me why, because they just care about making money. And that's a lot of the case. And it turns out, Gary, half the time, if they, as the individual, didn't read about that on their own, the bank or brokerage firm isn't in any big hurry to make sure that their beneficiaries are done. Now, however, there are good advisors in my industry. Don't get me wrong, and I'm not saying to anybody you have a great advisor. The full checklist will determine whether or not how good your advisor is. It's called the advisorectomy. But we're going to go through these little things, and we're going to find some things that you're going to see little by little. Are the people you're working with looking out for you? Or are they looking out for themselves?
They should be looking out for you.
They should be looking out for you, absolutely. So we're going to determine that with the full checklist.
I have got about 6 minutes.
What happens, by the way, if your money goes through probate, and now your kids have to come out of pocket to pay all these expenses. There may be an estate account set up, but what happens while that money's sitting there? Is that fair to them?
Of course not. Of course not.
And all you needed to do is a simple piece of paper, and it would have gone to them right away.
All they need to do is meet with you. What about fees? How does that enter into this on the checklist?
Well, Gary, fees are super, super important to us. So we want to be able to buy good things. So people understand you have to pay some money for good things. But should you be paying money for things that you don't need to be paying for? Unnecessary fees, so hidden and unnecessary fees. And one of the other key tenets of that would be areas of concern. You may be paying unnecessary account fees or costs. So we understand that, do you want to buy the cheapest product, as cheapest, the bestest ever?
Normally, no.
Normally, no. Now, for certain exposures, you know what? If you buy the cheapest S&P 500 index fund, you're going to be fine. But remember what happened. You're buying the cheapest fund and you're getting what? 40% of your money's in 7 companies or 10 companies. Is that what you want? If that's what you want, fine, buy the cheap. Now, there's other companies that might charge a little bit more that don't have all their money sitting in the Mag 7. They might do an earnings weighted version, and their fees are really low. But they could be equally weighted, and you don't have the same. You have exposure, but you don't have the same risk or similar risk that you do to the S&P 500, 7 companies popping. So what we do is we go through several different fees with people. It could be fees on their variable annuity. It could be fees in their brokerage account. It could be fees inside their IRA. And there's so many different kinds. Like you have the first one I'll talk about, Gary, is an expense ratio. And the expense ratio, when you look at your investments, it'll say the expense ratio can be identified in the prospectus, and it's frequently used to pay marketing costs, distribution costs, and management fees. So it's not just, you get that shiny piece of paper talking about your annual report for your fund in the year. That comes out of your pocket. They're not paying for that. That doesn't come for free. Then you have things like brokerage commissions. The more these advisors trade or the more your mutual fund manager's trading, the more it's going to cost, right? These guys are doing big block trades. So if they're trading often, they're going to have a problem. That's going to impact you. So we expose that. It's called the turnover cost. So we also look at market impact costs, and this occurs when investors, mutual funds managers is buying and selling large quantities of stock that drives the price artificially higher or lower because they're buying big blocks of stock. Now, they're going to the dark pool. They're going, but still, the bottom line is the market knows there's a big buyer. The market's going to know. And that's going to, people are going to jump on that, and they're going to either piggyback you. It's going to be costing you more for your trade. That's why you try and be as secret as possible, but it's not always possible. Spread costs. This occurs when a mutual fund manager buys and sells stocks for mutual fund owners, so that there's a spread on that. And then tax costs. So we want to talk about taxes too. We want to see how much are you paying in taxes. So I've seen funds. Morningstar has a great tool, a tax tool. And I've seen there was this one fund that was like the whipping boy we would use, and it showed like an 8% rate of return. And then when you do the after-tax return, it was somewhere around 4%. Oh. So it had a 50% what we call a tax drag on it. So we want to analyze that for our clients to make sure they're not overpaying taxes on money they're not using. Because if it's not in an IRA or a Roth, that money, those taxes are being passed on to you. And I can't tell you how often we see people with these old stodgy mutual funds that they should be getting out of which we know how to do, by the way, get out of to get them into more efficient, lower cost, more tax efficient investments. I can't tell you how many times they get a hit with like a $20,000 or $30,000 capital gain on their taxes. Yeah, and they're like, oh, what's that cost me? Like, well, it's about $6,000. And like, yeah, well, I got a couple mil. What's $6,000? $6,000, Gary. That's not just $6,000 this year. It's $6,000 what? Next year, the year after, the year after. So you take that $60,000 over 10 years. That's without compounding. You compound that. Think about what that would be. How much money they're leaving on the table in taxes on money they're not paying. So we really pay attention to the bottom line. We do not pass capital gains on to our clients or to capital gains taxes. So that's a huge, huge deal. We do our best not to. It's impossible to avoid 100%, just like anything, but we get pretty close to zero.
When somebody says, well, it's too late for me to sit down with you, is it ever too late for somebody?
No, I brought clients on at 89 years old.
Wow.
Very large client. They were with an advisor. The average fee, this is like my record for the 21-point checklist. Their average fee for the individual funds was like 1.8% management fee. And I'm being kind to this guy. Turnover costs were literally on this account over $50,000. But all I had to do was get to the first $45,000, and they were overpaying this guy. And plus, he was charging a very large management fee to them, 89 years old. And I'm like, you know what? I think we did the checklist with them at 89, and we got them to move their money.
Good.
So because they were like, you know what? We grew up in the Depression. We saved every penny. We don't need to pay this advisor. They were paying the advisor 1.5% plus 1.8 on the funds. I mean, it was just a low-hanging fruit for me, but I couldn't even bother telling them what the turnover cost was because I was afraid that we might have had a cardiac arrest, Gary.
Folks, you've been listening to On the Mark with Mark Pappa. You can find him online at www.f as in Frank, rplan, frplan.com. Financial Resources Group, by the way, out of Glastonbury, Connecticut. And, of course, right now, as the show is wrapping up, would be the most opportune time for you to call them. If now doesn't work for you, call later on today, the rest of the weekend, sometime into early next week. Bottom line is to call him ASAP. It'll be one of the best phone calls you've ever made for yourself, maybe even for your family. 860-657-8380. One more time, and I'll slow it down. 860-657-8380. For Mark Pappa, I'm Gary Byron. Thank you so much for listening to On the Mark. Until next Saturday morning, have a good one, everybody. So long.